Hello and welcome to this Providence Meet the Manager session. My name is Justine Morton. I'm a Senior Investment Advisor at Providence Wealth Advisory, and today it's my great pleasure to introduce you to John Zeckendorf, Principal and Co-Founder of Mandala Asset Solutions. Nice to see you, John.
Nice to see you. Thanks for having me.
Providence has been investing with Mandala for some years now, since before I joined Providence actually, John. And so I thought today we'd sort of delve a little bit deeper into what you do at Mandala Asset Solutions and in your regional hospitality funds.
Wonderful.
John, can you tell us a bit about your background and how you came to form Mandala?
Yes, Mandala's been around for 21 years. We started out of a background in insolvency, which we started in the late 80s, early 90s, including a bunch of property and hotels. We'd spent some time overseas working for the Brunei royal family, came back to Australia and started Mandala. So we've been going for quite some time. It's a partnership between myself and a guy called Ryan Shaw.
And what characteristics do you look for in a property when investing?
We're looking at a bunch of things. Firstly, what is it currently doing and what's its potential? What could it be doing? A lot of the properties we look at have the ability to add value if you can bring expertise and resources and compete in a way that other people can't. And so one of the things we love about playing in the regions is most of our competition isn't very sophisticated. And it means then we can bring in a sales team, we can bring in renovation, we can bring in all sorts of things to lift value and lift performance of that property. And that's one of the things we love about what we do. It's actually pretty easy to add value.
Can you talk me through a little bit about how you construct your portfolio?
Yep. So we have four main verticals that we're looking for. We're looking for towns that have drivers of government business. And that can be things like defence, it can be medical, it can be healthcare, it can be all sorts of things like that, education, but things where the government has to pull money into people travelling into that town. And that's one of the big things we're looking for. We're also looking for agriculture. People have got to eat. That tends to be fairly stable. It can be affected by drought, but there's a reason that people have to go to that town, and it's driven by whatever the agriculture is. We also look at mining, all types of mining. And the main reason for that is it's still one of Australia's biggest industries and one of our biggest exports. And then we're also looking at domestic tourism. Now, some towns have all of those attributes, and some towns just have one. So we're looking at where is the basis of our portfolio. Does that have a heavy weighting to one area but ignoring the others? Or do we want a more rounded property that has a bit of balance in everything? So towns like Wagga tick all four of those boxes. People have to go there for a whole bunch of different reasons. If you go to a town like Port Douglas, that's really only ticking the tourism box. So we can balance the portfolio depending on what we're trying to achieve in the balance of those four elements.
And will you look Australia-wide in terms of the properties?
We do everything in Australia, but we are a regional hospitality fund, which means we don't do the major metros. For a couple of reasons. Firstly, there's a lot more competition, and secondly, the yields aren't as good. And so it's harder for us to get the kind of returns that our investors and we would like to receive.
So John, we've just come through some pretty interesting inflationary conditions and seen some steep rate heights. Certain property sectors have been hit pretty hard and probably some more pricing adjustments to come. Can you talk me through how this has affected regional hospitality and how you've navigated these conditions?
Yeah, absolutely. So there's a lot going on in regional hospitality and all property at the moment. There's probably two main factors in it. One is the impact of interest rates themselves, and the second is the impact of inflation. For most property owners, inflation is less of an issue for them because they're just receiving a passive rent. And so higher inflation means their rent will increase over time. To some extent, we have that element in our business as well. But higher inflation actually affects us also because we're a trading enterprise. And so on the trading side, the cost of our wages and the cost of our supplies goes up as well, which means we need to put our prices up. The nice thing about higher inflation is that actually the customer is willing to pay a higher price. They expect prices to go up because inflation is higher, and they're willing to pay more. That allows us to diffuse the higher costs that we have. And that's actually been really important for us in the last couple of years because actually it's been a big win for us. We had stagnated in terms of the price the market was prepared to pay, but now we've got to a point where the market is willing to pay a higher price for our product. So in some ways, inflation has actually helped us in the last couple of years. The second element is what happens as interest rates go up. As everyone knows, a year or probably 2-3 years ago, you put your money in the bank and you got pretty much nothing. Now you can put your money in the bank and get 4 or 5%. And so people's expectations of rates of what the returns they want for being invested jumps up. And that leads to what we call rate decompression. People expect a higher rate, that can affect prices. Regional hotels never actually compressed as much as city properties did. And so we had maybe compression as the interest rates were dropping down, we had maybe compression of 1%. And so to some extent we have decompressed, but it's only been 1%. Whereas if you look at commercial properties in the city, they may have decompressed 3, 4, 5%, much bigger numbers. But we never had that compression in the first place. And so we're not finding the decompression as painful as some other sectors are.
And margins, how have you found your margins?
Margins are actually doing much better because we have been able to put prices up. People are expecting to pay a little more with inflation, and that's worked well, particularly if you can get the quality up. People appreciate value. A lot of our competitors haven't renovated, they're not quite sure, they don't have the sales and marketing team or the social media team, and they're really struggling to be able to put their prices up because they can't point to more value. We're constantly renovating our property, we're constantly bringing new ideas in, we're constantly doing lots of little upgrades, and people see that stuff and go, yeah, I'll pay more for it. So actually we're finding our margins, I wouldn't say improving, but we're holding them, which is nice.
Speaking about interest rates and what we've seen, the pressures that have come through, how's the portfolio positioned at the moment in terms of gearing?
So we've always been because our background is in insolvency, we've always been ultra conservative on borrowing, and we've got a hard cap at 50%. So if we buy a property for $100, we'll only put $50 of debt on it. But we then fund all our capital expenditure through equity. So by the time I've put another $10 of renovation on there, my loan to value ratio is actually much lower than the 50% I started off with. And then over time, the value of the property increases as the returns increase, and that's meant that we're able to actually have, at the moment in some of our earlier funds, our loan to value ratios are probably in the 20s. And we never top up our loans. So interest rates don't affect us as much as other things. There is a direct impact because of the gearing, but it's not as profound as it might be in more highly leveraged groups. We do use hedging as well. We've got a whole range of hedging strategies from fixing to collars and a whole bunch of other things, and we get some fabulous advice on that, but at a macro level we kind of understand what we're trying to achieve, and at a micro level we rely on the advisors to tell us exactly how to achieve that.
John, I know from discussions that we had last year, finding staff was a real challenge. Now that we're seeing a little bit more immigration coming in and unemployment seems to be sort of moving a little bit, how have you found the staffing pressures? Have they eased a little?
A little, and for a bunch of different reasons. Interest rates going up have meant that people now want to work a little bit harder to maintain the lifestyle that they had. And so we're finding people that a couple of years ago wanted to earn, $500 a week, they now want to earn $600 a week, which means they're willing to work more hours. So we found that's probably the number one factor, particularly in the regions. A lot of the immigration has ended up in the cities because a lot of the regional immigration schemes have been reduced. And so we're finding actually that probably helps city places a lot more than it helps regional ones. Where we have been able to work, we've done a joint venture because of our scale. We've been able to do a joint venture with a university who can bring out students. Those students are allowed to work, I think it's 20-25 hours a week at the moment as part of their student visa. But we're also able to give them, because we've partnered with the university, we're actually able to give them additional paid hours that count towards the on-the-job training they're doing in their course.
Oh, great.
And so that's actually opened up a whole bunch of new workforce for us, particularly in things that are quite hard to get, like chefs and so on. But it also means they can't leave us. So for the period of their visa, which is usually about 2 or 3 years, they actually have to stay with us, and that's made a huge difference.
John, can you tell us a little bit about what you invest in the funds?
So we invest in regional hospitality. That sounds like pubs, but actually we won't touch pubs, and we won't touch anything with gaming. and we won't do development. Outside that, we can do anything that is an accommodation-driven business, and that can be everything from a backpackers at one end right through to a luxury resort at the other end, and pretty much everything in between. So a typical property for us would be in a town like Orange or Bathurst or Armidale or Toowoomba or Bunbury, so big regional centres, and it might be something like a 50-room property, and it's mostly accommodation driven. We do serve alcohol as part of a restaurant. We may operate a bar as well, but we don't make most of our money from alcohol. We actually make it from accommodation. The alcohol is incidental to the food that people require when they're there, and that's really, we're looking for accommodation-driven businesses.
So I was going to ask you about ESG actually, and how you consider responsible activities as part of your mandate. Can you talk a little bit further?
Yeah, absolutely. So we do, in terms of governance, we've got very robust governance structures. We have an independent advisory board that actually one of the key managers of Providence sits on that advisory board for our current fund. And their job is to keep an eye on us, to vet investments, to deal with any conflicts of interest, and to provide guidance and wisdom. And we take that advice very seriously. We have independent custodians and trustees, and we're audited, and there's lots of checks and balances and multiple levels of management. So we do actually have diversification of roles and so on. So that's in terms of the governance side. The environmental side, we do what we can, but to be honest, we appreciate we can't shift the dial in a meaningful way. So while we do what lots of other people do, and we use solar and we recycle and we have all those sorts of programs, those sorts of things are actually difficult for us to add value because of the nature of the business we do. Where we really excel is actually on the social side. We are often one of the larger employers in a town, and we take that position really seriously. So we're interested in building up leadership of not-for-profits within the towns we're in. We're interested in inputting into the local communities and becoming not just an investor in that community, but an investor of the community. And we put money into particular programs that will actually help each individual community. So sometimes that might involve an Indigenous program if it's a town that has an Indigenous problem. Other towns don't have a problem, or it's already well funded, and we'll look for other ways where we can engage the community in various projects and build up the towns that we live in and we operate in.
Are occupancy rates holding up?
There's no simple answer to that, I'm afraid. So firstly, occupancy rates are a trade-off between the price you charge and how many people are willing to pay that price. We can play lots of different parts on the demand curve, and sometimes I'd rather get a higher price at a lower occupancy, or the other way around. And so we manage what's called yield management, a bit like the airlines. Sometimes you pay $50 for a flight, and sometimes you pay $500. They're managing the trade-off between occupancy and return. And so we do the same thing. We have a yield manager or a team of yield managers who actually go through and every day look at prices, even multiple times a day, on what we should be charging for a room to manage our occupancy. In terms of demand generally, what we're finding is most sectors in the regions are actually less variable in their demand. If you're in agriculture, if it's been a good year and the rain has been what you need and the sunshine's been what you need, it doesn't really matter what you're charging for a hotel room. You actually need to have the team there to run the support for your combine harvester. And so it doesn't matter whether it's an extra $20 or $50 because you need to bring the crop in. For government services, they have services that have to continue. If they have to bring a doctor in to do some surgeries, then if the room's an extra $50, they're not that sensitive. And so it is really managing all of those factors. We found generally demand is pretty strong at the moment. The towns that have been most affected are towns we haven't invested in. At the moment there's a lot of press about young people with high mortgages and how they've been smashed by the interest rates jumping up. They tend to stay at towns that we don't actually invest in. And so we haven't been as badly affected as some others. If we had, for example, Byron Bay, you might find that's a place that attracts a lot of those younger people, and they're probably feeling it a lot more than we are in a town like Orange.
In which states of Australia are you seeing the most interesting buying opportunities at the moment, John?
Interesting is a variable term. And so I think WA generally has come on our radar. We've tried before in 2016, but things weren't right and the timing wasn't right, and we had a transaction that we were very keen on, but the vendor decided not to sell for family reasons. So we're a little bit upset about that, and it's taken us through COVID and past COVID now to get back into WA, which we've just done about a year ago. We love WA. The returns are higher. The risk is manageable. And as long as you get that balance between those four factors we talked about, you can actually end up with a superior return with less competition and a lot of old, tired hotels there.
Oh, really?
And so from our point of view, we're buying hotels, some hotels actually we're buying at about $80,000 a room. And then we're putting another $20,000 of renovation into those rooms, and we're ending up with a property that is making a fabulous return because our cost base is so low.
And what would you pay comparatively in the eastern states?
Eastern states, you'd already be buying on a lower yield, so it's making less money than the WA one, but would be buying that room for between $200,000 and $250,000.
Wow.
So there's a tremendous advantage on both sides in terms of value you can add, but also the base at which you're starting from. So yeah, we'll continue to push west. We see the same thing in the Northern Territory, and for tax reasons, South Australia. There's no stamp duty, so South Australia can also be attractive. So we will push into, we're already in Northern Territory in WA, but we'll make further investments in both of those.
What sort of rates of return are you forecasting to generate in the fund going forward?
So different funds have different returns. Fund 2 has been around for 8 years, so its returns should be much higher because we've done an awful lot of value add over the years. But Fund 3, which is the new fund and the fund that is both raising and deploying money at the moment, we're targeting an 8% cash distribution, but that will be an average over 5 years. In the earlier years, that will be a little bit less, and in the later years, as renovations and marketing and so on kick in, I would expect that to grow into double digits and beyond, which is exactly what's happened on Fund 2. And then on top of that, you have capital growth, which we would expect to be at least the same again, to give up an all-up return of something in the high teens.
The fund has a longer dated maturity. What's your exit strategy for investors?
We've got multiple exit strategies. What we found in Fund 2, which is the investors have actually, so Fund 2 started 8 years ago, which means we came to the end of our fund life late last year, and we went back to investors and said, who wants to come out? You know, do you want us to sell? That is the default position, and we will start selling assets and getting you out of this, which is what we told you at the beginning. And actually nearly 90% of our investors said, we don't want to get out. We like the returns, we like the cash, you're just going to generate a lot of tax for us, and then where will we deploy the asset or the money? So 90% of our investors said, keep going and keep doing that for as long as you think these assets are good. So we actually got a very strange mandate to continue the fund for another 5 to 10 years was the resolution.
And what did you do for the 10% who didn't
The
want to?
10% who wanted to come out, we actually, by coincidence, we had an asset we weren't happy with, and we thought it's a good asset now. It's been a fabulous asset, but that part of town is changing demographically, and this is no longer a good part of town for us to be invested in. The town is good, but this part of town is bad. We were starting to see more massage parlours and tattoo houses and a lot of social housing kick in, and it was changing the dynamics of the town, and it was becoming to the point where guests were starting to feel uncomfortable. So while things were good, we sold out of that, we used that money. We actually had some incoming investors who said, gee, we wouldn't mind taking a slice of that. So we actually pretty much in a few days managed to take out 10% of our investors and be able to take them out of the fund. So there's always a measure of liquidity. We don't promise liquidity, but the very small number of people that have wanted to come out over the years, we've always been able to find a way of taking them out.
And Fund 3?
Fund 3, we've only had a few investors leave, usually sadly because they've died, although quite often their children look at the asset and say, we'll keep that rather than selling it. So we have had a lot of inherited investors who are second generation who have picked up mum or dad's property. So Fund 3 has the same sort of liquidity. But we think at the end of Fund 3 we'll probably be big enough to actually look at a wholesale exit. So that could be through listing, it could be through selling all the properties together en masse, or it might actually be sort of breaking it down, splitting up property companies from trading companies. There are lots of different ways we could get out of this through what's called a roll-up. And what we're expecting is that will then lift the returns from the 18+% we're counting on individual assets. If we can get a wholesale exit away by being big enough, then we think that can jump up to much higher returns again. We're not promising anything, but that's where we're heading.
And finally, do you have capacity to take on new investors?
Absolutely. So the fund, we've always been constrained by how much money we've had to deploy, not by opportunities. There are about 300 opportunities per year that come up in our sweet spot, and we might buy 2 or 3 of those. So the chance of buying 4 or 5 of those is very doable. So there's no shortage of opportunity. We've got plenty of management bandwidth. The returns don't change, they're still good, and there are plenty of fabulous opportunities out there at the moment. And so yes, very keen for new investors.
John, where are you seeing the most interesting opportunities at the moment?
Well, apart from the geographic ones we talked about, we're seeing a lot of owners have been running their properties, and most people don't like change and they don't like stressful situations. I'm an insolvency person, so I actually don't mind those sorts of challenges, but most of the owners of these properties don't like that stuff. And what we're seeing is they've been through 2 or 3 years of lockdowns and radical changes in the market. Then they've had no staff and tons of demand, and they've made really good money, but it's killed them. And there is an element of PTSD. They have been through a bunch of traumas. They were possibly already burnt out by the time this all started, but they haven't been able to sell for a while. And suddenly it's not about the price they're selling it for. They've made enough money, they've recovered from COVID, all that sort of stuff. They just need to get out. It's time. And so we're seeing a lot of those opportunities. As interest rates have gone higher, we're also seeing a lot of people who are committed elsewhere and they need to sell an asset, and this is the one that's occupying a lot of time for them, and they don't really understand it, so it's time to get out of this. So we're seeing a lot of non-core divestments. We're also seeing a whole bunch of stuff that the fund probably isn't allowed to invest in because we are aiming at conservative positions here. We're not looking for high risk opportunities, but jump up the risk curve slightly outside what the fund can do. We're seeing some really fun stuff that where you can actually do some creative deals, provide solutions for people, but get the kind of returns that you should be for taking that kind of position.
So will you do this more opportunistic style investment as well outside of the fund?
We normally do that outside the fund because our advisory board actually keep us honest and keep us on track. And we often approach them and say, here is something that doesn't quite fit the fund criteria. Do you think it's appropriate for the fund or not? They're usually pretty good at saying, yeah, nah, great investment, but not that, not for the fund. So we do tend to keep the fund fairly pure on those focuses.
We like certainty, yes.
Indeed. Well, it's also, we'd like to deliver what we told you we were delivering. But what we find is we then circulate our investors and say, something else has come up that sits outside the fund. Would you like to join a syndicate? And then that lets investors have an opportunity into those sorts of opportunities also.
Well, thank you, John, for your time today. It's been great talking to you. Thanks for joining me today. I hope you found the session with John very interesting and informative. If you'd like to hear more about Mandala Asset Solutions and the Trinity Hospitality Funds, then please reach out to your advisors. See you soon.